Well, let's get back to Jeffrey Kleintop. He is our guest from Charles Schwab. And Jeffrey, I'd love to hear your thoughts on the swings in French politics that we've seen recently, from the almost certainty that we were going to see the far-right party do very, very well in the National Assembly to this left-wing coalition that includes, as Oliver Crook just told us, some very far-left parties.
Yeah, so maybe gridlock is good, at least here in the early days. I mean, since the first round on June 30th, we've seen French markets begin to recover, both the bond spreads and in the stock market, on the idea that we're not going to see, sweeping fiscal budget-busting changes. In fact, we've got all three leaders of those three groups have vowed not to work together on domestic policy, which essentially leaves us with gridlock, along with President Macron remaining in charge of France's international relations and trade policy. So I think to some extent that is good news. And I think we will see that the spread between France's and Germany's debt narrow a little bit further, and maybe French stocks continue to rebound. It's interesting to see that the French stock market has been tracking what we saw in the UK stock market back when Liz Truss's spending program back in 2022 was rejected by the markets. They backed away from that, and we saw markets recover. It's remarkable how the charts line up almost perfectly. I posted that on my X feed this morning, lining up, and that would suggest further upside to France's markets as the market begins to recognize that the idea that we're going to see some budget-busting spending proposals seems very unlikely.
Okay, let's get to sectors of the U.S. Stock market. Technology in particular, it outperformed again in the first half of this year. I believe your view is investors need to be cautious about how much tech exposure they have, and they need to understand how much tech exposure they have.
Yeah, the U.S.'s stock market essentially acts like a tech ETF. And so if you have all of your assets in the U.S. stock market, you do have an enormous amount of tech exposure. And tech has been led lately by semiconductors, really driven by the AI theme. And while we've been very positive on that theme for well over a year now, we've grown a little bit more cautious and worried about some of the valuations and the high expectations, particularly going into this earnings season, recommending investors consider some diversification away from the sector that's been a dominant leader for some time. Think about financials, energy, materials. Those are our three favorite sectors for the second half.
Let's talk about financials. That sector will be in the spotlight at the end of this week when the big Wall Street banks begin reporting their results.
Yeah, it could be better news there, particularly for investment banking. We're starting to see things improve. And the outlook for a steepening yield curve in the U.S. could be good news as well. Our outlook is for a couple of rate cuts by the Fed later this year, and that could move to a steeper yield curve, generally a good thing for financials.
And you like energy as well.
Yeah, I think energy prices can begin to move higher here. They've moved up a little bit. I think the market's still expecting prices to come down on weaker economic growth, but the global manufacturing recovery remains intact. We think solid demand for energy will keep those prices at these levels or higher, helping to lift the energy sector.
Why don't we finish with your view of the Canadian stock market, which posted a reasonable gain in the first half of this year, up about 4% or so, but obviously lagged in a big way the U.S. Indices?
Yeah, historically, the Canadian stock market behaves like the energy and the financial sectors. And so those are two of our favorites and think that'll perform well. I think one of the keys is whether dollar strength continues. And we do view a couple of rate cuts later this year should begin to eat away at some of that dollar strength that's really helped the U.S. stock market lead this year. That could be favorable for Canadian equities.
What is your view on when the U.S. Fed begins cutting rates, and how many times this year will it cut rates?
We penciled in a couple of rate cuts, probably September and December. I think we've seen enough in terms of the weakening of continuing claims for unemployment benefits, even though if initial claims aren't necessarily picking up, the number of people continuing to receive unemployment benefits is suggesting weakness in the labor market. The decline in the PMIs below 50, the purchasing managers indices for services and manufacturing indicating contraction, consumer sentiment taking a dip, and now the core personal expenditures deflator, the Fed's favorite inflation metric, down to 2.6% and falling. All these trends are deepening, suggesting rate cuts in September and December are likely.